Is your money locked up? I mean, literally, have you put your money somewhere where you've locked the door and thrown the key out? Most people do, by statistics. If you look at where people's money is, trillions, tens of trillions of dollars are in 401ks and qualified retirement plans. And what happens when you put your money in a qualified retirement plan? You lock the door and you throw the key out until 59 and a half. But you could always hire a locksmith to pick that lock, but they're going to charge you, right? Well, the IRS would charge you 10% and taxes on that money if you wanted to tap in to those retirement funds before 59 and a half. But you see, that's not where it ends. People tap into money in CDs. They lock their money up in CDs, thinking, oh, this is great, I'm getting a good return, but they can't access that money without a penalty, without giving some of that interest they earned back. And I could go on and on about this, but literally, is your money locked up in a jail cell that you created for it? Well, here's what happens if it is. You're missing out on opportunities. You're literally missing out. If somebody came to your door with the greatest financial opportunity of your lifetime, could you take advantage of it right now? Or is your money locked up? And if you took it out, you're going to have to pay too much to take advantage of the opportunity. Well, I can tell you this, people all the time miss out on opportunities for this exact reason. And today, I want to show you how you don't have to lock your money up, how your money can be liquid and available to you. So it is time for you to literally take back control of your money and keep your money out of prison. Stop locking your money up. First off, let me tell you what I did. You see, back when I had a 401k, I had a 401k because I worked in corporate America. I worked as a financial advisor, and I put money in that 401k because that money was a tax deduction and I got a match. Woohoo! We love those matches, don't we? Free money, my grandma said. But is it really free? No. So here's my suggestion. If you're putting money in a 401k, I'm not telling you to stop. Matter of fact, I'm not giving you financial advice. I'm simply saying, well, maybe you should consider backing down what you're putting into the 401k and just put in up to the match. Because as my grandma told me, free money is good money. Even though it's not completely free because of vesting schedules and all the other things that come along with it, it's still your company giving you extra money. So put in up to the match, but let's talk about the above and beyond the match, where that money goes. Now, if you have not been living under a rock, you probably know I talk about the infinite banking concepts. And I teach people how to become their own bank. And we use a machine, I always like to call it a machine, called a whole life insurance policy. Now, before I tell you anything about the specially designed whole life, let's just talk about a whole life. When you think about a whole life, and you think about putting money into that whole life, premiums, does that feel good? No. You don't like making premium payments, do you? You want to make deposits into your bank. You want to make deposits into that 401k. So let's just change the way you think about the premiums. Let's now call them premium deposits, because when I'm done, you're going to see why they are deposits and not just premium expenses or premium payments. But if you put money in a whole life, is that money locked up? Well, most people would tell you, oh yeah. You can't get that money that you put into that whole life for at least 2, 3, I've even heard people say 5 years. I actually just saw a video on TikTok where this idiot said that whole life has a surrender charge. No, man. Surrender charges are in universal life and IULs. Whole life doesn't have surrender charges. But in a traditional whole life, sold to you by your broke-ass brother-in-law or maybe your sister-in-law, we're not going to call her broke-ass, but maybe they weren't thinking to specially design and engineer their whole life. They just sold you what they were taught to sold. Now they got a big commission. And guess what you got? A regular whole life where you did lock your money up for 2, 3, 4 years. But what if you didn't have to? What if you just found somebody like us that knows how to design and engineer a whole life so that that money is available immediately in the first 30 days? That's right. That's not locking your money up, is it? Well, that's how we build them. We design and engineer whole life policies to give you access and liquidity to your money immediately. It may not be all of your money. And this is one of the biggest complaints I get, or not complaints, but one of the biggest objections I get when I show people this concept in this machine is they say, yeah, but in the first couple years, I can't access all my money. Right you are. And the reason for that is the insurance company charges a cost of insurance. They charge money for that death benefit. So, therefore, in the first couple of years while your money's going in, you certainly will have access to it, but not all of it. So people ask, how much? 60 to 90%. That's the standard response. Depending on how we design it, you will have access to 60% of your cash value, up to 90% of your cash value. And the cash value is derived from your premium deposits that you made. So although you don't have access to all of it, let's talk about why that's not such a bad thing. Hey, let's just pause real quick because I need you to do something for me. I've been giving all this value to you. So here's what I need. I need you to click that subscribe button right there. And there's a little bell right up top. Yep, right there. Smash. Cash. Oh. Oh. Well, thank goodness. It just woke him up out of a deep sleep. Cash, you okay? Good boy. All right, I'll let you go back to sleep. Well, say hi to everybody. You don't have access to all your money, so you're gonna make premium deposits into a specially designed whole life. And you're gonna have access to a percentage of that money, and that's called your cash value. But the beauty of doing it this way is that once you put the money into the policy, that money starts earning interest. And it gets a dividend every single year. Now, those aren't guaranteed, but every year with the companies we write, they have paid dividends consecutively for well over 100 years. So I don't think they're gonna stop this year. So you get guaranteed interest plus a dividend, and that money is compounding. But here's the beauty. When you go in and you take a loan from your policy, your money, as long as it's designed properly, continues to compound. Isn't that cool? So you now found a way to save money, but you can still spend that money and not interrupt this compounding effect? That's true. Your money continues to build while you now have access to that money. Your savings account can't do that. There's very few other financial vehicles that allow you to do this, and most of them don't work anything like the whole life does. So now you've got your money compounding uninterrupted. You've got access to your money to go out there and make money a second time. So what you've just done is unlocked what all the wealthiest families have figured out many, many moons ago, and that is how to make money twice on the same dollar. So now you've found a way to make money twice on the same dollar. But some of you are still facing that objection, that thing that I told you about not being able to access all of your money. As a matter of fact, the other day on a training, I had a nice gentleman bring this point up. We were talking about the differences between a whole bunch of different accounts, and we were talking about a savings account, a high yield savings account. And we were talking about the advantages of using the whole life over just investing from a savings account. And he was talking about real estate. And he brought up a really good question. He said, yeah, but Chris, if I use my savings and I buy real estate, I don't have to pay interest on the loan. If I use my whole life and I take a loan from the policy, I got to pay interest on the loan, plus I don't even have all the money to use. So wouldn't I still be better off using the savings? So this is where mathematics really come in handy. So what we were able to do is we were able to mathematically prove to him how using the whole life will benefit him. And here's how we did it. We ran a side-by-side comparison, real live time. Matter of fact, you can watch that YouTube video. I'll put it up when we're done here so you can check it out. And what we did is we said if we had money in a whole life and we had money in a savings account and we invested the exact same dollars into a real estate deal paying the same return, and we took the return from the real estate and we rolled it back into either the whole life as a loan repayment or into the savings account as just additional savings, which one worked out to make more money? So this gentleman was right for the first 2 years. So in the first 2 years, he would have made more money in the savings account than he would have in the whole life. But you see, by the third year, the fourth, the fifth, the sixth, and every other year there on out, the whole life pulled ahead. So this is a unique thing. So just imagine this. On a drag strip, I'm gonna line up two vehicles. One is a Tesla Plaid. Now we all know the Tesla Plaid. I don't like electric cars, but it is a fast car, one of the fastest cars out there. And then we line up right next to that Tesla Plaid an SR-71 Blackbird, the fastest jet ever made. It exceeded speeds of over 2,000 miles an hour. If we raced them down a drag strip, which one's gonna win? For any of you thinking the Tesla, you're right. In a drag strip, that jet had to fire its rockets up and build up momentum. Before that SR-71 hit its maximum speed, that Plaid would have crossed the finish line on the drag strip. But when we're talking about finances, are we really racing for a short period of time, or are we racing a long race? Because if we were to just extend that drag strip, that SR71 would blow the pants off of that Tesla Plaid. You already know that. 2,000 miles an hour versus what's a Tesla Plaid do? 200, maybe 215? Good luck stopping that thing at those speeds. The brakes on those Plaids aren't all so good. But the point I'm making is, how do you want your financial race to be? Do you want to be in the Plaid where you can sit there and say, I won in the short run? Or do you want to be in the SR71 where you won the long race? You would go faster. Well, that was the difference for this comparison. The savings account in the first 2 years was better, but because of uninterrupted compounding interest found only in the whole life after year 3 on pulled ahead, not just by a little bit. Let's just say that real estate deal that savings account was invested in paid 10%. And let's say the same 10% was earned on the money from the whole life. Even though the whole life allowed them to use less money because you can't use it all in the first year, but that money continued to compound. So after the 3rd year, that 10% was more than 10. And then the 4th, and the 5th, and the 6th, it went from 10 to 12, to 12 to 15, 15 to 20, 30, 100% as you went down. 100% return? How can you make that when you're only earning 10 on the real estate deal? When every single dollar is earning compounding interest, of course, the whole life is the SR71 in the long run. So the real question when looking at either one of these vehicles is, what is the race you're racing? What do you want your money to do? Because if you're just playing the short game, this isn't going to work for you. But if you're playing the long game, this will always trump that savings account. And I know in the game of finance, you don't want to just get rich. You want to get wealthy. Because the difference between rich and wealthy is people that are wealthy have figured out how not to give their money back. Compounding interest allows your money to always work for you and allows your money to continue to keep building whether or not you work harder, longer, or take on any more risk. But there are additional objections that always come up with the whole life, and I hear this all the time. People will say, yeah, but Chris, what if I can't make my premium deposit? And that's a very viable thing. You lose your job, you take a demotion, something in life happens, and you can't come up with the money that you initially thought you were going to be able to. No problem. The way we design policies allows a lot of flexibility in your premium deposits. We could even design your policy to hold $1,000 a month, and your minimum might only be like $150. So that's your minimum, but you have the ability to put in up to $1,000. I'm just using those as round numbers and examples. We design these plans to have massive flexibility. So if things like that were to happen, you just reduce the amount of your deposit during that transition phase, that period of time when you're looking for another job or talking to your boss about not the demotion, getting a promotion. But whatever it is, these policies are built to accommodate that. Now, what's the worst possible thing that could happen if you did the whole life? Well, the worst possible thing is you stop making premium deposits, your policy lapses, and you would lose whatever money you didn't have in cash value. If you put 10 grand in and your cash value was only $8,000, how much did you lose? $8,000. If you lapse the policy. You see, inside of a whole life, that is the only way the insurance company wins, is if you lapse it. Because then the insurance company keeps that difference in what your cash value was and what your premium was. And usually that difference with the way we design these will only be a difference for the first 2 to 4 years. Anything after that, you're gonna have more cash value than the premiums you put in. So if you were to cancel or lapse the policy later in life, it doesn't matter. You got all your money back and then some. So that objection is only a problem in the early years. And again, are you sprinting to wealth or are you running a marathon? Life is a marathon and so is building wealth. So the whole reason I did this video was about locking up your money. And I want to really get you to start thinking about where you're putting your hard-earned savings and whether or not that money is being locked up, because I will tell you this one thing right here, right now. Your money is worth the most that it ever will be. Because of inflation, your money next year will be worth less and less further down the line. And I can prove it. How many candy bars could you have bought 10 years ago for $1? The simple answer is way more than you can today. Why? Well, because your dollars are worth less in the future. So wouldn't that mean you want your dollars available today to take advantage of opportunities today? Why put your money in a place where it's locked up and you can't use it for 5, 10, 15, 20 years? And in 20 years, your money certainly will be worth significantly less, even if you have a higher balance. Stop playing the finance game backwards and start getting your financial house in order. And hey, listen, while we're talking about this, hey, you remember that video I mentioned earlier? Well, check it out. It's right here where that guy posed that question of whether or not a savings was better than a whole life in that real estate investment. I think you'll enjoy it. Well, thanks for joining me today. We'll see you on the next one.